Welcome back to Fundamentals of Accountancy, Business and Management. In this video, we're going to be discussing the accounting equation. Content standard. The learners demonstrate an understanding of the accounting equation. Performance standard. The learner shall be able to solve problems by applying the accounting equation. Learning competencies. The learner shall be able to illustrate the accounting equation, perform operations involving simple cases with the use of accounting equation. By the end of this video, you're expected to understand the elements of the accounting equation and use the accounting equation to solve problems. Now let's have an overview of the accounting equation. These are the things that you will learn in detail in this video. The accounting equation is assets is equal to liabilities plus equity. For every transaction, the accounting equation should always be balanced. Now, assets, which is the first word that you can see in the accounting equation, let's define this one. Assets are resources owned by the business. It could be cash, furniture, equipment, and things similar to them. We're going to have a more detailed discussion of assets in the next video. Next would be liabilities. Liabilities are obligations by the business. Could be accounts payable, notes payable, and similar other things. It will also be discussed in detail in the next video. And the last one is equity. It is the residual interest of the owner of the business. So residual interest. Equity would include the capital that was invested by the owner or the owners, and also the income. It will be increased by the income that the business earns. And the detailed discussion of equity will be in the next video. Now, there are 4 elements that affect this equity. It would be investment, withdrawal, revenue, and expenses. We'll be discussing these things as we move on with the transactions that we're going to look into. Now, let's start with the presentation of the accounting equation. So you have here assets is equal to liabilities plus owner's equity. Just like what I said earlier, these both sides of the equation should always be balanced. If there's an increase on the left side on the assets, there should also be an equivalent increase in either the liabilities or owner's equity or both. If there is a decrease in asset, then there should also be an equivalent decrease on the other side. It's either a decrease in liability or an equal decrease in owner's equity, or it could be the total decrease in asset would be equivalent to the combined decrease in liabilities and owner's equity. Now let's look into some transactions and see how each account would affect the accounting equation. Assets invested by the owner. July 1st. Paulo Reyes started the delivery service on July 1st, 2013. The following transactions occurred during the month of July. He invested 800,000 pesos in cash and cars amounting to 200,000 pesos. In this transaction, you can see in here that the business received cash amounting to 800,000, and cash is an asset account. So cash goes in here, and the amount is 800,000 pesos. And then cars were also invested, amounting to 200,000. Cars are also an asset, so we put cars in here, amounting to 200,000. Now, this cash and cars were invested by Paulo Reyes. Therefore, it is but right to have this Reyes capital account as his equity in the business. So Reyes capital amounts to 1 million. How did it become 1 million? It's a combination of 800,000 and 200,000 cash and cars that he invested into the business. So as you can see in our accounting equation, the left side, which is the assets, we have 800,000 and 200,000. It's equivalent to 1 million. And on the other side of the equation, we also have 1 million in here. So our accounting equation is balanced. Let's move on to the next transaction. The first one that we studied was assets invested by the owner. Now, we're going to look at the effect of the accounts when we borrow from the bank or when the owner borrows from the bank. July 2, Reyes borrowed 100,000 pesos cash from PNB for use in his business. In this transaction, Reyes, again, is the owner, right? He previously invested cash and cars, and now he borrowed an additional 100,000 cash from PNB. That means from 800,000 cash that we had on July 1st, it will increase by 100,000. That's from the loan that we got from the bank. So 800,000 cash plus 100,000. Now our cash is 900,000. Okay? And this one is an increase on the asset. It's an increase on the left side of the equation. Therefore, the other side of the equation should also increase. And that increase will go to loans payable. Why is it loans payable? Because that money, that 100,000 cash, was borrowed from a bank. So it is loans payable amounting to 100,000. Now, if you're going to get the total of both sides of the equation, this one is 900,000 plus 200,000 is equivalent to 1.1 million. And on the other side, you have 100,000 loans payable and 1 million Reyes capital. So this is also equivalent to 1.1 million. So our accounting equation is still balanced. Next transaction. So from borrowings from the bank, now we're going to discuss asset purchased for cash. That means that the business bought an asset, and we paid in cash. Okay? July 7th, bought tables and chairs from Orocan and paid 45,000 in cash. What did the company receive? We received tables and chairs, and this is usually recorded as furniture. So furnitures, the amount is 45,000. In this case, bought tables and chairs from Orocan and paid 45,000 cash. That means from 900,000 less 45,000, now our cash is 855,000. Okay? Again, from 900,000, we paid 45,000 cash for the tables and chairs. Therefore, our cash is now down to 855,000. So let's take a look if our equation is still balanced. You have 855,000 pesos, 200,000 pesos, and 45,000 pesos. If you add this up, this will be 1.1 million. And on the other side, we didn't make any changes, right? So 100,000 and 1 million, that's also 1.1 million. So our accounting equation is still balanced. Next transaction. From asset purchased for cash, now we're going to talk about assets purchased on account. What is the difference between the two? In this case, we bought asset and we paid cash. In this case, we bought asset and we haven't paid anything. Okay? Now, July 15th, various equipment were purchased on account from Fortune for 55,000 pesos. The company or our business received equipment, and the amount of the equipment was 55,000. So we record it here under the assets. It's equipment worth 55,000. Now, in this case, we didn't pay cash, so there wouldn't be any changes in our cash balance. Instead, it was purchased on account. So that means we have accounts payable. Accounts payable is our obligation. It is something that we have to pay in the future. So since we bought equipment, but we haven't paid anything, then we have accounts payable. And this accounts payable amounts to 55,000 pesos. Now, if you're going to add this up, it's from 1.1 million, and then we added 55,000. Now it's 1,155,000. And on the other side, it's 1,155,000. So our accounting equation is balanced. Next transaction. From assets purchased on account, now we're going to look into cash withdrawal by the owner. When you say cash withdrawal, that means that the owner got money from the business for personal use. So July 18th, Reyes made a cash withdrawal of 5,000 for personal use. If he made a cash withdrawal, that means from 855,000, our cash balance would be less 5,000. So 855,000 less 5,000. Then now our cash is only 850,000. And the equivalent account on the other side would be Reyes drawing. This is the account that we use whenever the owner withdraws money or anything from the business for personal use. If they put money or cars or something else in the business, it would be recorded as capital. But if they get something from the business for personal use, it will be recorded as drawing. So this is Reyes drawing, and it's 5,000. As you can see, this in parentheses, that means this would be deducted from the owner's equity account. Remember, withdrawals or drawing accounts are deducted from the capital account. So if you're going to check both sides of the equation, this side, your cash, cars, furniture, and equipment, this will be equivalent to 1,150,000. And on the other side, this is 1 million plus 100,000 plus 55,000 less 5,000. So it's also equivalent to 1,150,000 pesos. Still balance. Next transaction. From cash withdrawal by the owner, now we're going to talk about payment of liability. That means we're now paying the payables that we had in the past. July 20, the account due to Fortune was paid in cash. If you can still remember, let's go back to the purchase. This one. Assets purchased on account on July 15th. We bought various equipment from Fortune, but the equipment that we bought was on account. That means we didn't pay, right? That's why we had accounts payable on this side. Now, we're going to pay for that liability. On July 20th, the account due to Fortune was paid in cash. If we paid in cash and the amount that we recorded before in the accounts payable was 55,000, that was the amount of the equipment, right? That means we're also paying cash of 55,000. So from 850,000 less 55,000 payment for Fortune, now our cash balance is 795,000. Again, from 850 less 55, because we paid the accounts payable from Fortune, then our cash now is 795,000. Then what is the equivalent on the other side? We paid cash for what? For the accounts payable. So before, we had accounts payable of 55,000. That was on July 15th. We had accounts payable worth 55,000. But now, we have paid for it. So, we don't have accounts payable anymore. That means the liabilities and owner's equity side is now less by 55,000. Okay, so let's try to compute. Now this side is equivalent to 1,095,000, and the liabilities and owner's equity side is also the same, 1,095,000. That's 1 million plus 100,000 less 5,000. So 1,095,000. Still balanced. Now, this table summarizes the effects of these transactions on the accounting equation. This is the summary of the transactions that we discussed earlier. And remember, the first one was assets invested by the owner. So that's 800,000 in cash, and then 200,000 worth of cars, and the total was 1 million. So 800,000 in cash, 200,000 worth of cars, equivalent to 1 million Reyes capital. This will be the same process that we're going to have for the other transactions. So Reyes borrowed 100,000 cash from PNB. So that's 800 plus 100. This is the loan that we got from PNB. That's why it became 900,000. We still have the same value for cars, no change. In loans payable, we had 100,000 because we borrowed from PNB. So this one increased by 100,000, and then no change in Reyes capital. So our balances, cash is 900. That's this one. Cars is 200. That is this one. Loans payable is 100. This one. And then Reyes capital is 1 million. That is this one. Now, for July 7th transaction, we bought tables and chairs from Orocan and paid 45,000 in cash. So that's 900,000 less 45,000 because we paid in cash. And then there's a decrease in the cash account, but there's an increase in the furniture account. So the furnitures increased by 45,000. So now the balances become 900 less 45. So that's 855,000. This one. The car, still the same. It's 200. And then for furniture, we have 45,000. Then same for the loan and also the Reyes capital account. Next is the assets purchased on account. Again, assets purchased on account means the business bought something, but we haven't paid cash yet. This one, there was an increase in the equipment. So we have a new account, equipment, that's for 55,000. And there's also an equivalent increase in the accounts payable, and that is for 55,000. So our balances now, no change in cash, no change in car value, no change in furniture value. Now we have an additional account. It's equipment of 55, that's in there. And then same value for the loans payable. And then we have a new account, that's accounts payable. That's here for 55,000. And then the same value for Reyes capital. Now, the next one was the July 18th transaction when Reyes made a cash withdrawal of 5,000 for personal use. The effect was only in cash and also in equity. So from 855,000 less 5,000 withdrawal, now the cash is 850. No change in the car value, no change in the furniture value, also equipment, loans payable, accounts payable, and Reyes capital. But we have this new account, Reyes drawing, for 5,000. Again, remember that drawing account is a deduction to the equity account. So we put it in parentheses. If it is in the parentheses, it means it will be deducted. All right. So our balances, 855 less 5,000. That's 850,000. No change. No change for the rest. But we have an additional account, which is in parentheses. This is for 5,000 pesos. And finally, we have this. The account due to Fortune was paid in cash. So paid in cash, that means from 850, we paid 55. Now the balance is 795. No change in the other accounts except for the accounts payable, because we paid for the accounts payable. So from 55,000, we paid 55,000. Now the balance is 0. So if you're going to add the left side, that's 795 plus 200,000 plus 45,000 plus 55,000, it amounts to 1,095,000. And then on the other side of the equation, you have 100,000 plus 1 million less 5,000. It is equivalent to 1,095,000. So as you can see, our accounting equation is still balanced. Again, be reminded of the accounting equation, that is assets is equal to liabilities and owner's equity. And then after reviewing the transactions, we were able to see what we had in the overview earlier, that for every transaction, the accounting equation should always be balanced. And in the transactions that we looked into, there would be effects on either assets, liabilities, owner's equity, but in the end, the accounting equation is still balanced.